I'm guessing you do not care about arena football at all.
You know what? I don't know that that's true. Like, I
Really?
really love football. I haven't been able to get into the UFL the way that they would love us to, based on the number of commercials that run when I watch regular TV. But anytime I'm sitting still and I have the free time, football's football, I'll watch it. I don't love arena football more than, the others. I don't know that anybody does, but I'll watch it.
So this is an important distinction, though. The UFL is not arena football.
I know.
The UFL is played on a 100-yard field.
It's not the NFL, which is the peak of like talent and you've made it. And then there's the UFL, which is where maybe you'll have 2 guys a season that'll actually get called up to walk on to be on the practice squad of a NFL team. And then you have arena football, which is basically the guys that just got out on work release or parole that are like trying to do this to keep themselves occupied so that they don't end up back in jail. So like that's the hierarchy of who plays where in each league.
Did I send you the photo of the arena football player playing with an ankle monitor?
No, I was joking.
I know you're joking, but there's an image, and I'll send it to you after the show, of a player for the Cincinnati Slingers, where it's over the sock, but many observers believe that he was playing with an ankle monitor.
Yeah.
And I think this is so interesting to me because and right now I have the monumental task of making you, the listener, care about arena football, which is unlikely because people, investors, leagues have tried to make people care about arena football for over 3 decades now, since the late 1980s. And I think that I'm getting to this point where I'm trying to follow the money of it, which I think is interesting. It is this like example of why do we keep trying the same thing over and over again? And I also think it could be a representation of one of the darker parts of the American dream. Which is if you try hard enough and you work your way up, maybe you'll make it to the NFL. And you have this shining beacon on a hill of Kurt Warner. He played arena football, then he made it to the NFL. And maybe you played at a D3 school and you believe that the scouts weren't looking at you like they should. Well, this is a way for you to get your tape in a developmental arena league and then go up to another developmental arena league. And maybe, just maybe, you're going to make it in the NFL.
So it's predatory, it sounds like you're saying.
Well,
because you're playing for like $500 a game or $1,000 a game. It's not going to be life-changing money. Like you could make more money working for Chick-fil-A and have health insurance and not have a 300-pound man landing on top of you 6 times a Sunday. And so there's a lot easier ways to earn a buck.
That's a generous estimation. I think it's between 1 and 200 for a lot of players right now.
Jesus. Okay.
To play arena football. And not only are you having a 300-pound man laying on top of you, which we'll get that image out of your mind in a moment, but you're having a 300-pound man hit you into a wall.
Yeah.
And I think that there is like when I am watching these clips of arena football, I have this uneasiness with sort of just trying to fit a square peg into a round hole, which is that football, to most people's eyes, it's not played in an arena. It's played on a 100-yard field. Kickoffs should not hit the back of nets and then bounce into someone's arms. People getting tackled over a hockey wall. Maybe there was a moment in the 80s or 90s where viewers go, yeah, big hits. But I think now there's a greater unease with that, where to your point, you're going, wow, I think these guys are getting paid a few $100 a game and you just took a massive blow to the skull. Now I'm a little worried about that. So,
and that was the promise of the XFL too in the early 2000s was it's way more aggressive than the NFL. We don't have those, softy rules around here. There's no fair catch on kickoffs. We want to see blood. And that didn't really go. I think that company has changed hands like 3 different times since then as well.
Yeah, that was a Vince McMahon project. But one of the commonalities with the XFL, arena football, and even these more minor league teams is they go after sort of celebrity investors. So I've seen it with the minor league teams where they're like, hey, you were an NFL wide receiver. Let's get you on the ground floor of this arena league where we're just getting started. We're going to start getting more people through the door with ticket sales and marketing. We have a whole plan for it. Our YouTube channel has grown a staggering 48% over the past year. Notice how I use that number there. And once the media sponsorship's coming in, this thing's really going to take off. And there was someone on LinkedIn, former wide receiver, saying, eventually I bowed out of it because you're just selling me on a promise, not actual cash flow. Mm-hmm. And so on the investing side, there's this like, hey, let's see if we can get some celebrity investors who either just have money to piss away or may not know better, and bring them into this incredibly expensive business where, for the indoor football league, I was looking through their documents, the average yearly budget is $420,000. And it is $300,000 just to join the league. So the startup costs in year one are going to be much more expensive when you have to build the field, you have to build out the personnel, maybe you have to market a little bit more. But there's an investing angle here, which is we're going to try to get some money from people who may or may not know better based on this big, sexy promise of, wouldn't you like to be the owner of a professional football team?
Well, the sovereign wealth funds have infinite money as long as their chief product can someday make its way out of the Strait of Hormuz. So there is the chance that bigger pocketed investors come in behind you and are able to sort of lift everything, be the high tide that raises everybody's boat. And that's probably the ultimate promise too, is like, we're going to finally make our way over to the Middle East, bring back some of that Saudi money, and that's what's going to propel this league. Like, there's a ton of soccer leagues now that exist that didn't exist, or teams, let me say, not necessarily entire leagues, but there's entire teams now that exist that didn't 5 years ago, because suddenly the world got set on fire and is interested in soccer globally. So much so that the money that you're talking about from these professional athletes, you have what's this guy's name? Patrick Mahomes owns a soccer team while he's actively playing in the NFL. There's a handful of other more veteran players like himself that actively own stakes in soccer clubs. There's actors that own stakes or own entire soccer clubs. And so it's brought this whole popularity to the sport that keeps bringing more money and more money behind it until we finally hit the sovereign wealth fund jackpot that makes this whole thing make sense.
Which, by the way, the Saudi Arabia Public Investment Fund, the PIF, will stop funding Live Golf, their golf league, after the 2026 season. So they are starting to pull back a little bit.
Well, that one was a failed experiment, but I think that's also to send money in other directions, because there's basketball, which we haven't talked about, which is also grown a ton in popularity, especially women's basketball, since Caitlin Clark set the world on fire. And so now you've got women's leagues that are developing globally. You've got the big three for, should have retired a while ago NBA players that allows them some ownership and also the ability to extend their careers. And so you got basketball happening, you got soccer happening, and also flag football has sprung up out of nowhere as we get ready for the Olympic Games in LA. And so there's a much better formula for where I can position those dollars that cost less. The health of the players is less of a concern. We don't need as much space to be able to play. So all that to say, like, arena football is always going to be a challenge. And you're also up against the NFL, which is the holy grail of live sporting events today.
100%. And I think what you just described, I will be interested to see how many of those experiments take off. Where the big three basketballs, that's Ice Cube, right? And you can have an element of, older basketball players, but those are still big stars, right? And you have, with basketball, that's a more personality-driven sport than football. Yes, you have your superstars in Patrick Mahomes, but just simply not having a helmet and being able to see players' faces and emotions during basketball games is a huge difference.
Well, that's where I think flag football starts to creep up, because if I can see 40-year-old Patrick Mahomes, who can't be on an NFL field running around and dodging tacklers anymore, I'm happy to watch him play 5 more seasons in a pass-only league where it's 7-on-7 basically, but I do get to see literally Patrick Mahomes' face on the sideline the whole time and on the big screen and whatever. So that's another reason why I think that supplants the UFL and arena, because of the popularity of the individual players, and it's only the skilled position people that are going to matter in that.
So my wild prediction is that there will be a Savannah Bananas for football in the next 5 years.
Okay.
Because that's what's taken off. And I think you're going to see a lot of those like personalities, TikTok dance driven football game. But I don't think it's going to be tackle. I think it's going to be some sort of flag football where you can use like, hey, we have our, you were a wide receiver at Georgia, but you didn't quite make the NFL. We can have a super high level of talent, and then we can bring in special players to throw the first pass or be a part of like having bands play in the middle of the field and really do up the halftime show, even more so than the NFL is doing right now. I think that's a place where it'll totally make sense. Last thought on this before I stop boring you with arena football until I bore you again. I didn't realize these leagues are tax exempt. I learned it is these leagues, the indoor football league is a 5016 business, which is tax exempt, which means you can look at their tax records, but they're not paying income taxes on it because they get categorized in the same category as like Rotary clubs or, business trade organizations where we're not a business, we're promoting business. So therefore we don't have to pay taxes on it. And then looking through the forms, the only people making money appears to be the league commissioner of the indoor football league. And also somehow his gym in, I believe it's Iowa, Tryon Gym was awarded $112,000 from this indoor football league. So there's some questions about where the money's going.
That also helps to explain why it's attracting large dollars from celebrities and athletes and entertainers in general, because their business managers are constantly out looking for opportunities for them to defer income into some tax sheltered vehicle. And if this is a way, I'm not saying specifically that it is because this is the first that I'm learning about their status, but if this is a way for you to defer future income, then that could also be why they're willing to tie up dollars in this way that doesn't necessarily make sense on its face.
I think that's a heck of a bank shot because it's the league, not the individual teams that I think are getting those dollars. So anyway.
But sometimes like I see some of these soccer clubs where the team owners also own shares in the overall structure of the league itself. At least the initial founding team owners, like the first 8 or 10 that built out the league, have an ownership stake too in the overall league. Like there's a Rory McIlroy and Tiger Woods investment fund that is specifically for developing sports leagues. So one is basketball, I think, and one is flag football, or one's soccer and one's flag football, if I remember right. And like, they own a stake in the league itself, and then they also themselves are fronting a team. And so they'll get paid a million different ways. But in the meantime, they've sunk however many millions of dollars into this thing that they get to write off as a business loss for the time being.
All right, we're going to talk about prediction markets. I want to talk a little bit about MicroStrategy and if AI can really trade stocks. And after the break, Malcolm is going to explain why people may want to defer income, even if you're a non-millionaire sports owner who is not participating in investing in arena football. All right, let's get into it. Malcolm, this was kind of a joke, kind of not, because you brought up deferring income. And I think for listeners, a listener may wonder, why would you ever defer income? And basically, the basic premise of that is, let's say you're making millions of dollars and you know that gravy train will eventually stop. Mm-hmm. So baseball players do this all the time. Hey, you can just pay me later. And that's when I'll be in a little bit of a lower tax bracket potentially. And that's like the main reason why rich people want to defer income.
Yeah, you said it, but not even a little bit of a lower tax bracket. If you think about, since I'm already talking about him, Patrick Mahomes, right? He plays in 10 different cities a year, 10 different cities in 10 different states every year, which means then that he has to pay income taxes in all of those different states that he plays a football game in. And why that matters so much is for a guy that makes, $100 million a season or something, his Sunday game checks are several millions of dollars per, which means that he then is also having to pay income tax on several millions of dollars each Sunday because they only actually earn their income over 18 weeks. So anyway, you would want to defer any income that you stand to receive from any other venture that you happen to be involved in until you're presumably retired completely and you don't have that kind of income and complexity in your tax return, so that that income's not also being chopped up a million different ways at the uppermost income tax bracket. And you can instead be a retired 40-year-old with no real means of active income coming into your house. And at that point, you're in like the 12 or 22% or 24% income tax bracket. And it's a lot more feasible to be earning those dollars, those distributions back from whatever sports venture you've invested in. Because again, obviously now it gets taxed at a much lower tax threshold. So you get to keep a lot more of those dollars when they might even matter to you a little bit more because you're no longer actively earning those game checks and you're trying to keep the whole thing running.
All right, that's our arena football to football personal finance corner. Find another show that does it. If you're listening, especially on Spotify. So my pitch is Savannah Bananas for flag football. But if there's a sport you would put your own dollars into, doesn't have to be one we mentioned. I'm curious what it is. I like these hypotheticals. Let us know in the comments of this Spotify episode, and maybe we'll bring it up on another show. Anyway, that's what's been on my mind this week. Malcolm, what have you been talking about on CNBC that's actual stock stuff?
Yeah, the big conversation right now that I find myself on the I guess if you're a person who's been on a debate team, you get broken up into for or against. And so I find myself on the side of the against, even though I'm not necessarily against this market. But what I'm talking about specifically is we keep having this conversation now of, is this moment we're currently in with the AI build out and everything that's being powered specifically by 4 companies that are investing $700 billion combined dollars into their AI build outs in 2026 alone. Is that sustainable? Where do we go from here? Are we at the tipping point of another 2000 like market crash where we should have all known, like, we can't keep hitting these higher highs forever? And the argument that I keep getting from those who are in favor, or those 4, is that we haven't seen the outrageous valuations on companies, Microsoft, Google, Amazon, and Meta, the way that we did in 1999 when the writing was on the wall, when you saw a bunch of companies trading for, 80 times, 100 times, 120 times their forward earnings. And you should have known better because those companies, a lot of them weren't even profitable. And in this regard, those 4 that I just named especially are actually cash generators. They just happen to be choosing to invest that cash right now into further build out. My argument is we're not looking directly at those 4 companies when we say, things have gotten out of hand and this sounds similar to the way that it did in 99. We should be paying attention instead to like the semiconductor stocks where Intel, for example, is up like 200% year to date on a couple of really good announcements, but not necessarily much more than that. Micron is up, I think, over 100% year to date. Broadcom up over 100% year to date. And you compare that against an S&P, as we're talking about it being at all-time highs, that's still only like 9-ish, 10% year to date. And so by comparison, the broader stock index is doing okay, but it's not blowing it out of the water the same way all the semiconductor stocks are. Then you also go look at all the neo cloud companies like Iron that just got set on fire all over again. You got Nebius, you got CoreWeave, a lot of other ones that are like even further long shots than those 3. And they're rolling and like doubling your money every 6 days. And so when I look at the fractals around the companies that are doing the spending, the ones that are doing more of the receiving of those dollars instead, that I think is where all of the oversaturation of investment has gone. That is where I think the irrational exuberance among shareholders has gone. And it's all being held up by 2 companies, Anthropic and OpenAI, who account for 50% of all of the remaining performance obligations of the 4 companies I started this conversation with: Meta, Microsoft, Alphabet, and Amazon. So those 4 companies combined at their last earnings just reported $2 trillion worth of remaining performance obligations. And 50% of that is due from 2 companies, OpenAI and Anthropic. And those 2 companies supposedly are going public before this year is over. And I think once one of them does, and I think it'll be Anthropic before OpenAI, and we finally get a chance to see how they earn their cash, how they spend their cash, and what the likelihood is that that ramp continues to go at the rate that it's been going, we won't like what we see. And that is what's going to send this whole thing cascading down on itself.
So once you get sunlight, it's going to be a little bit of disinfectant. Now,
for sure.
I will say, this is something I said on a previous show, and your counter to this is you can only sell so many memory chips. For a company like Micron, which is up 156% year to date, I think it's up some crazy amount over the past 12 months, but 156 year to date, that company's still at 9 times earnings, 9, which even for like on a forward earnings basis, that's not hyper expensive. Now, if they lose their pricing power because let's say OpenAI pulls out of some remaining performance obligations, then that's when you're going to see some of the investor excitement, that's when you're going to see investor excitement go away. But I think your point is well taken, which is that this is not 1999 all over again, because it can't be, because we're in 2026, but there is a rational exuberance, to your point, in these small cloud companies where people are going, just buy me cloud stocks. And if you have one of the legs of the stool get kicked out, you're going to see a lot of people flee.
Yeah. And I think I think we've seen several times during this build out cycle where investors are extremely skittish the moment a whiff of bad news hits the tape and the selling pressure mounts. And it's mostly led by retail investors who have also been the ones leading this bull market that started in November of 2022 when ChatGPT showed up. And that is also who I expect to lead the stampede out of these names and bring the market down on top of itself. And so I'm not saying all this to say like it's time to go to cash. I am, very aware that the party can keep going for another year or two before any of what I'm talking about or something else tangentially related shows up and causes the fun to stop. I'm just saying that folks who aren't paying enough attention or feel like I got to keep getting because the getting is good, be hyper aware that this is where it starts to get dangerous to be trying to build a position in a lot of the names that we're talking about that have already run so much, because you're likely toward the end of the cycle, not necessarily the middle or the beginning.
You sound like Michael Burry. I'm taking on this Michael Burry approach.
And I don't mean to, I don't want to, like I said, I am staying invested. Like I've been trimming in places that I feel like I could get crushed way too fast and it would hurt. Yeah. But for the most part, like I'm staying invested. I'm just looking around and saying, like, for everybody who's whistling past this and saying the concerns are 2 years down the road or more, like Paul Tudor Jones was on CNBC last week, and he's a big get for them. And so when he talks, everybody listens. And so he was basically making the argument that this feels like Microsoft's build out in 1995, 1996, not so far out into the cycle where we're talking 1999. Yep. And that then means in his mind that we still have another couple of years where the party can keep going before the music stops. And I just don't think that that's the case. Because another thing I haven't even mentioned to throw into the mix here, because it would take us down an entire different rabbit trail, is the idea that public sentiment for data centers has completely shifted from where it was 3 years ago, 2 years ago, 12 months ago. And you have places that are super integral to the overall data center build out, like Colorado, Arizona, Texas, Virginia, where entire neighborhoods have become extremely hostile toward their local elected officials and are planning to do everything they can from a grassroots perspective to toss any and everybody who voted for legislation in support of data centers out on their butts. And so this all probably comes to a head sometime in November around the election anyway. At least that's where a huge hiccup is likely to come, just because now we've got to digest how fast can we continue to run with this build out, where the administration, no matter how in favor the Trump administration is, drill baby drill, it's at the local level that it really matters.
Did you see Eddington, the movie Eddington?
I didn't.
Interesting movie that is very much about the data center build out and where people spend their political attention.
Is this a 5-hour YouTube video you're asking me to watch?
5 hours. It's a 2-hour movie. It's on Max. It was one of my favorite movies.
I just want to make sure before I add it to my list.
2025. You don't need to watch the 5-hour YouTube video.
Okay.
I recommend it. I've recommended it to listeners. I don't expect anyone to sit through it. But to your point, I mean, just on a personal level, do you want a data center in your neighborhood? Because it's not like build outs of the past where these things are coming in and creating jobs. We're building this specifically for AI. It may create a few jobs, and they haven't figured out the small modular nuclear reactors that are going to power this thing. Mm-hmm. And I don't see how you can make a compelling case that if a data center pops up in your neighborhood, that has no impact on your electricity bills. And you're seeing stories where people are having issues with their water. It's an incredibly personal thing. And I completely understand why people are saying, no, we do not want this in our area.
Yeah, not only that, you already had, I think it was last week, the Information had reporting on the fact that Microsoft is figuring out a way, quiet as it's kept, to rework their green pledge so that it doesn't require them to be on the hook for as much of their power usage as they initially pledged to. And, I have to assume like they're not alone. Like this is a chief concern for all of the companies that have made these big pledges that like, we'll pay our fair share of how much we increase the electricity. We'll figure out the water sources on behalf of the places and whatever. Like, I have to imagine all of the companies doing the building are in the same place right now where they're trying to figure out a way legally out of what they agreed to just 12 months ago.
Oh, that was one of my favorite stories of the carbon credits. Mm-hmm, and what often happens with this is a large company will take a big, let's say I am the CEO of Ricky and Malcolm's oil company. I'm going to create a green pledge that we will be 100% carbon neutral by, let me say, 2062. Mm-hmm. And I'll do my best in the early years, but that is my pledge to you, is that in 20 or 30 years from now, when I'm sitting on the board of a think tank and trying to pay off political candidates for my own means, that's when the real green pledge is going to come in through this company. And, it's one of those things where I think enough people have realized that if a company takes a pledge on something, they don't actually mean it until you see meaningful action on it.
Yeah, I stopped even getting requests from people for ESG style investments probably in 2018, 19, because it became very clear to the public that really all they were doing is committing to plant trees in one place while they polluted in another place so that they could offset each other. And when you go to invest in like a ESG focused ETF or something, the top 5 holdings still were like Apple, Microsoft, Google, IBM, and Exxon Mobil or something. And everybody's like, well, why is Exxon in here? And it's like, because they're the biggest pledger to plant trees in Colombia. And that's going to offset all the drilling that they're doing.
I think enough people realize that you don't need to trust, let's say, BlackRock for a morality score for your own investing. Like, I will find morality in community and religious organizations in my own internal self. I don't think I need to trust these scores coming from institutional investors that are telling me what is good and what is bad.
Yeah.
This episode is sponsored by Capital Area Planning Group. Capital Area Planning Group is a fiduciary wealth management firm that specializes in helping high net worth individuals and families navigate the complexities that come along with managing concentrated stock options, multiple income streams, and an ever-changing tax code. While our team of certified financial planners are well-versed in all things personal finance, our areas of expertise include equity compensation, estate planning, and multi-year tax planning. At Capital Area Planning Group, we believe in pricing transparency. That's why our fees are posted on our website, right alongside the various services we perform on behalf of our clients throughout the year. If you're tired of receiving the same cookie-cutter advice from your financial advisor, then don't wait. Reach out to us today at capgllc.com to experience a better approach to wealth management. Again, that web address is www.capgllc.com.
All right, I want to get into prediction markets. So on the business side, I think that this is interesting for Robinhood because Robinhood has been getting punished this year. And one key reason for that is that people are not trading crypto anymore. I think their crypto transaction revenue is down 47% year on year. But prediction market revenues have more than made up for it. And so I think investors are looking at this and saying, oh, you're not getting the crypto revenue anymore, but do you actually care if the players at the casino moved from blackjack to roulette? They're still at the casino. And, as I'm looking at Robinhood, crypto and prediction markets are a big part of it. They're seeing revenue growth of 15% year on year. They're juicing more revenue out of the people there. There's a lot of bullish signs, but something you've said on the show, which I think is a big question, is once people get serious money, are they going to stay at Robinhood or are they going to go to the adults table of a place like Charles Schwab?
Yeah, I've had the itch to buy Robinhood stock as a trade probably twice now in the midst of the sell-off that they've been going through since, I guess it's like December of last year. Basically, the stock's still down like 30% year to date or something after two massive legs down. So I see it the same way as you just framed it. Like, who cares if, initially everybody was coming in and losing their money on blackjack and now they moved over to the craps table. The house is still winning. Yeah. And winning like bigly. And so like, do I care? The reason I haven't pulled the trigger on it and just keep saying like that would make me feel like terrible for cashing in that way is because I feel like I would be owning like cigarette manufacturers in the 80s and 90s. And I just don't want to have that be a part of my portfolio, even though I know there's some misalignment between what the company is actually doing and what Wall Street's giving them credit for right now.
Yeah, I don't know if I have the moral boundary like that, which I mean, I don't mean to say that as like an amoral person.
No, I know what you mean.
I don't know if that's the line that I draw. Granted, I also haven't pulled the trigger, so I'm doing a hypothetical on a hypothetical here. But for me, one of the big questions is like, do they need to build an RIA to tell that story? Do they need to eventually tell a story that people are going to keep their money here for decades as they build wealth, and now we can do the financial advising piece? And
well, that was the reason why they bought Trade PMR.
Yeah. But
and I think that was a good next step to make sure that they do retain folks as their money is growing up.
But since they started reporting RIA assets under management, Q1 2025, S&P 500 is up over 20% since then. The amount of assets they have there is flat.
Yeah. Yeah. No, I mean, they probably had a ton of defection. They probably had a ton of questions around like, why would I use Robinhood when I've already been working with this independent advisor over here? I think the battle that Robinhood is going to have to fight in that regard is to convince a number of really important advisory firms, independent advisory firms, to trust them with their clients' assets instead of Charles Schwab or Fidelity, which basically own the entire independent space. And like, I can tell you as a person who runs an independent firm, like that is a very steep hill to climb.
Yeah. Because I mean, two questions with that. Why would you move the money over? Because that's a huge, I have seen a custodial transfer during the what was it when Schwab bought TD Ameritrade and seen what a pain in the butt that is. And then the second, so one, do you want to go through that process? And number two, why? Like, what are you going to get better from Robinhood for custodial management than you're not getting from Charles Schwab, who's good enough for trillions and trillions of dollars? So
that's the part that I think is where the rub is for these guys. When the SpaceX employees who love playing on Robinhood while they have a few $100,000 to their name, finally have their liquidity event, which could happen any moment now. How much of that money flies out the door and goes to a Fidelity or a Schwab versus what stays with Robinhood?
Yep. It's a great question that I don't have the answer to. But on prediction markets, that's where I've done some reporting. So if you want to hear my story on prediction markets, it's out on the Indicator from Planet Money. This is being released Tuesday. That episode is released on Tuesday as well. And I want to kind of recap some of the reporting and some of the things that I didn't get to as much. One of the key things with prediction markets that I think is so interesting, two key things. One, how much money goes to the top traders. So the Wall Street Journal found that more than 60% of the profits on call sheet goes to 0.01% of the traders on there.
60% of the gains go to 0.1% of the traders?
Yeah, let me say that right. On Polymarket, the journal found that 67% of profits go to just 0.1% of accounts.
Jesus.
So that means 2,000 accounts have netted a total of nearly $500 million. So there is a narrative around Polymarket, which is these are kinder than sports books because the fees are lower.
But either way, the house is going to win.
But either way, the house wins. In the case of Kalshi, you may be betting against Kalshi's own trading firm, or you may be betting against Susquehanna Quant Trading Group, which is the market maker on Kalshi. So I wonder if that narrative is going to take effect at some point where people realize, like, I'm not having fun with this anymore. I'm just slowly bleeding out money. Or, this is still a better casino than DraftKings, and ultimately it doesn't matter. So I thought those two facts were pretty interesting to me. But my reporting is really about what do you do about insider trading on these platforms? And Polymarket, to its credit, they tracked down the soldier who allegedly bet on the U.S. going into Venezuela. His name is Gannon Ken Van Dyke. And when you look at the indictment, he wasn't exactly slick with it, allegedly. Everything I'm about to say is allegedly for the rest of the show. Don't sue me. Don't sue me. This is like on Facebook when I write my posts that Mark Zuckerberg does not control the photos that I'm sharing here. But allegedly, the soldier did a couple of things. One, after he made the bet and there was a ton of attention on it, he asked Polymarket to shut down his account. And then he tried to change the email address that was associated with his crypto wallet. So Polymarket cooperates with the Department of Justice to track down this insider trader. They've also commissioned a group called Chainalysis, which does
who snitches on everybody.
Scooby-Doo style investigations across the blockchain to see who's doing what. But still, my central question with this that I haven't found a good answer to is, if someone is good at insider trading using crypto, can they get away with it? Because it seems like the soldier, if the allegations are true, he was sloppy with it. What happens when it's a smooth criminal using fresh wallets and privacy coins and moving money around? Because one of the whole points of crypto is that you can do sketchy stuff with it and not get caught. And yet what we're seeing with a lot of these investigations is that the IRS is able to find it, and independent investigators are able to track it down, especially at the points where you need to cash in and cash out.
I would argue that those days are over.
Okay.
Whoever is listening to this that operates in the gray as it relates to crypto one way or another, I am telling you, I have no official capacity to have this information that you don't have. But based on all of the reading that I've done and talking to people far smarter than myself in places that would know this, like different 3-letter organizations in the U.S. government, and people who are very connected within the different exchanges of our financial system, like, those days are done.
Yeah.
If you got away with it, if you have been getting away with it to this point, it's time to cash out and take your chips home. Because, like, just recently there was new guidance from the IRS that they're planning to send out notices to anybody who's ever checked the box and said, yes, I own digital assets at the top of the 1040 tax return in the last few years. They now want you to self-report all of the transactions that you've ever made in your crypto accounts everywhere. And basically, from my understanding, this is just conjecture here, I don't have any inside knowledge of this, but from my understanding, what that essentially is doing is creating a paper trail where you have said on the record, this is the extent of my trading activity in crypto since the beginning of time. And so now if we uncover new transactions down the road 2 years from now, 3 years from now, you are up the creek, and we've agreed on paper that you attested under oath that this is what it was. So here is your penalty, and you bet not say anything about it. That is what's coming. The precursor to that was the IRS going to all the brokerages like Coinbase and Robinhood and whoever else and saying, you now, starting in 2025, have to report all of the basis and transaction information the same way you do for anything else that's traded on any other exchanges, like if you were to sell or buy shares of Apple, as an example. It is all leading to, we are now coming after previous transactions that haven't been properly reported. And you can't even blame it on sloppy accounting and sloppy, data capture, because you've got AI spreadsheet tools that'll go grab all of that for you for $10 a month, access to, the platform. So anyway, I think the answer to your question is, if you are a person who has gotten away with this in the past because you were far less sloppy than this guy, good on you. But the days of you being able to be that smooth criminal are not even numbered anymore. They're over.
Yes, I hear what you're saying. I think the IRS is very good at its job. But what I'm getting at with these questions is, number one, the openness of international prediction markets puts a lot of players outside of the realm of U.S. authorities. Mm-hmm. So if someone's doing it, and they're in China or North Korea or Iran, or, pick your country. Okay, congrats, we found you. You were insider trading using crypto. Now what can we do? And it's sort of a race to see if U.S. authorities or international authorities are able to freeze those assets. Mm-hmm. And there's still what I believe is an industry in washing crypto, where there's Chinese cryptocurrency launderers that the IRS has investigated, to my understanding. There's privacy coins. There's allegedly private peer-to-peer transactions. So I think that what's happening with the IRS, yes, it is true. Yes, the IRS is very good at finding it, but there's still this whole cat and mouse game where people are going to try to avoid it. And all of this, or a lot of it, could be avoided by forcing all prediction markets, not just we have an onshore book and an offshore book, to follow know your customer rules. We're not using crypto wallets. We need to know the identities of the people trading here. But to the credit of these prediction markets, which I don't think they get enough credit for, is that these unusual trades stick out like a sore thumb. And that's because you can go through and see what those wallets are transacting. And, this account has made $400,000 betting on U.S. military action. What else do they have going on? Or who's behind that? Let's go find out. Whereas with some of these whale option trades on things like, I'm going to bet on oil declining right before a Trump Truth Social post, there's no visibility into what those accounts have or what they've done previously.
So here's my question to you. From what I know, you tell me if I'm wrong. You're not someone who is active in making these Polymarkets bets presently.
I did call sheet a little bit, but presently I use it just for information.
Yeah. Okay.
Which is useful.
So it's fair to call you prediction markets curious.
Yeah.
I am not even curious in the least bit. I could care less. So my question to you is, does more regulation coming to this space, more investigative action and authority coming to this space, make you more likely to decide to get involved, because now you feel like that 67% that has gone to the House all this time has to start to trickle down to the little guy, at least to some degree. And so now my odds have gotten even better, and now's a good time to start using it. Or does the fact that the IRS and the FBI and the DOJ and everybody else is now at this party too, does that make you less interested in it?
I'm going to disagree with the premise of your question, because I don't know if
that wasn't an option on there was none of the above.
Okay, then I select that. No, it doesn't make me more interested. And it's one one point I would make to that. So
yes, now tell me why I'm wrong.
I'm pivoting from your question. I'm doing an artful pivot.
Okay.
Is I don't know if the proposed legislation affects that. So what's been passed on prediction markets? Number one, it was a Republican Bernie Moreno bill that Senate and their staff can't gamble on prediction markets. And that was passed unanimously. Then there's I think it's like prediction markets or gambling bill that Democrat Adam Schiff, and forgive me, it is a Republican from Utah, have co-sponsored this bill. And their point is, why is the CFTC in charge of regulating what is functionally sports gambling? And I think that is a fair question. So it's hitting at that sort of gambling addiction piece. And then the one that well,
let me say really quickly before you move on. It's not that I think that the legislation that's been proposed at the moment is going to be what actually makes this a safer or more trustworthy environment. It's just the fact that people are even willing to sponsor legislation that they expect is going to get somewhere at this moment. Like directionally, I think that's going to bring a change that 2 years ago might have seemed impossible.
I think so too. And especially that, one of those bills is bipartisan, which this is not a very bipartisan political environment. And enough people have said, maybe it's a little odd that the CFTC is taking sports bets. And then the one I did more research into is the one from Senator Richard Blumenthal. And it's the prediction markets. It's like the Prediction Markets Integrity Act of Security and Integrity Act of 2026. And I said this to him, so this is not a secret. It is such a widespread bill. There's, removing the CFTC from regulating it, bringing in, state commissions to do so, functionally treating these as sports books, and also no live betting, no betting on college sports. That gets lumped into ideas like, no prediction markets involving war or assassinations, and also the creation of a national exclusion list for gambling and prediction markets, which I think is genius because a gambling addiction is, I think, the most harmful addiction there is in terms of like likelihood for suicide. So there really do need to be guardrails on this. And so one of my concerns with a piece of legislation like that is you've lumped so much in that maybe some of the good stuff gets washed out because you're trying to hit 15 different things. And so that's not a secret. That's something I asked him just from a political perspective. Why not go one at a time? And his response was essentially, this is such a big issue that we need to take a holistic approach to it.
Yeah. So going back to your initial point in bringing this up, which was that people have gotten so bored with crypto and they're focused now on poly markets and everything else. And what is the impact of that on like a Coinbase, which is down, Robinhood, which is down, and others that are similarly situated? I am of the opinion that people are more interested generally in crypto than they are in poly markets and even sports betting, because those two things are binary. You either win that coin toss or you don't. Whereas if I have money invested in some sort of long shot altcoin, at least there's a non-0% chance that I will make money on that bet. I might have to wait 6 extra months and hold on, to that particular token or whatever it is, but it's not zero. The same way that like a 0-day options trade or will the coin toss at the Super Bowl be heads or tails or, whatever. Those things have a very short shelf life. And I think that's what's losing the sizzle and separating people, in their attention span when it comes to this.
Well, I would add to that mention markets, which are going to be less exciting if/when Trump leaves office, because there's a lot of action on, what will a powerful person say? And I think markets on, what will Netflix say the word gaming in their upcoming earnings call? I think that's a little less interesting to people than, is President Trump going to say Sleepy Joe during his speech in Europe this week?
That's because it's like shaking a magic 8-ball. Like there is no cohesive process for how words come flying out of there. The same way that everyone else who is measured and on script and very regimented about how and when they use certain words and the inflection of their tone. And like, you will never, ever, ever find any other public figure other than maybe Elon Musk, because he's starting to get a little variable in the way that he speaks about Tesla specifically. You'll never, ever get another moment like this. So I completely understand your point that once he's out of the picture, like, it's not as fun anymore.
So I think that's significant. And to your point on Coinbase, what's interesting to me is, Brian Armstrong was the CEO of Coinbase, was interested in kind of messing with these markets, I would say, when he had a earnings call where he goes, I want to make sure I say every word in this mentioned market.
Yeah.
Which I don't know if he was just doing that for something in giggles, or because he was trying to, maybe it's a meta bank shot to say, hey, let's stay with crypto. You can't really trust this stuff. And now you're starting to see prediction markets eat crypto's lunch, regardless of the long-term effect of that. And if people eventually go back to your altcoins that may or may not 10x.
Are you accusing Brian Armstrong of playing 3D chess?
I'm saying it's a possibility. I'm making no accusations.
Or I guess it'd be 4D chess, because the only Donald J. Trump is capable of playing 4D chess. Are you accusing Brian Armstrong of also being capable of playing 4D chess in that way?
Do you remember the part of the show where I said everything I'm about to say is allegedly, and you can't sue me for anything I'm about to say? And by participating and listening in this show, you have functionally consented to the facts that you may hear ideas that may or may not be true. We have a disclaimer coming up in a few minutes anyway. So I would say that. I would say you can't get me. Anyway, I think that's a good place to end it. We have more topics that are going to come next week. We're going to front load a little bit of these recordings. If you have enjoyed the show, the number one thing you can do to help it is rating it and leaving a review where you listen. So on Apple Podcasts, that's where you can leave a review. And then on Spotify, you can rate it. Leaving a comment helps. And one of the things I really enjoy hearing from listeners is what you want to hear on the show, questions you may have, is that informs what we do. You can email us at thistimepod@gmail.com. I'm at Rick So Slick on social media accounts, and you can follow Malcolm at Malcolm on Money.
Information shared in this recording and by its guests represent the views and opinions of the guests and does not represent the views or opinions of the host. This content has been made available for informational and educational purposes only. This content is not, nor is it intended to be, a substitute for professional financial advice. It is always recommended that you seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your personal financial situation.